If the United States ever stopped paying its debt, the world economy would implode in less than 48 hours. Banks would freeze, markets would vanish, and every dollar in your wallet would suddenly mean nothing. Because what we call U.S. debt isn't just a number on a spreadsheet. It's the invisible architecture holding up everything from your mortgage to the price of bread. If it cracked, it wouldn't just be an American problem. It would be a global collapse of faith. If you love the real stories behind money and power, hit like and subscribe before we go on. Now, let's dive in. It started in 1790, when a young nation fresh from revolution was drowning in war loans. Most countries would have defaulted. Instead, Treasury Secretary Alexander Hamilton embraced the debt. If America could borrow and pay reliably, he argued, it would prove itself trustworthy in a world of broken empires. The gamble worked. The U.S. issued bonds and honored them. Investors bought in, and American debt became a premium product in Europe. The Republic didn't just win its freedom through war. It financed its future through faith. That faith became the foundation of U.S. power. Every era of growth, the railroads, the Industrial Revolution, the New Deal, World War II, was financed through borrowing. Debt wasn't a weakness. It was the engine of expansion. In 1944, 44 nations gathered at Bretton Woods to design a new economic order. They anchored the global financial system to the US dollar and the dollar to gold. Every major currency now depended on America's promise. After the war, the US held 2/3 of the world's gold reserves and half its industrial output. Foreign governments stored dollars as reserves, and when they wanted to invest safely, they bought treasury bonds. American debt became the world's savings account. But nothing built on faith stays stable forever. By the late 1960s, the U.S. was fighting an expensive war in Vietnam while funding massive programs at home. Dollars were leaving faster than gold could back them. Other nations began demanding metal instead of paper, and the vaults drained. Then, in 1971, President Nixon made the most consequential financial decision of the century. He severed the dollar's link to gold. Overnight, money was no longer tied to anything physical. Its value depended entirely on confidence and on the government's promise to keep paying its debts. That promise created what we live under today, the debt standard. Gold no longer backed the dollar the world's trust in U.S. treasuries did. America could now create infinite credit as long as the world kept believing in it. Treasury bonds became the safest asset on earth, not because they were risk-free, but because everyone agreed to treat them that way. Banks used them as collateral. Pension funds relied on them. Central banks filled their vaults with them. So when you hear about the national debt, you're not hearing about a bill to be paid. You're hearing about the core infrastructure of global finance. Every loan, every derivative, every credit card rate sits on top of it, and the system depends on one ritual. When old bonds mature, the U.S. issues new ones. It never repays. It just rolls it over forever. As long as that continues, the illusion holds. But if the chain ever breaks, if the government misses even one payment, it shatters instantly. The risk-free asset wouldn't be risk-free anymore. Within hours, liquidity would vanish, banks would stop trusting each other, and the dollar would plummet. It's happened before, on a small scale. In 1979, a processing glitch delayed treasury payments by a few days, and interest rates spiked immediately. In 2011, Congress's near failure to raise the debt ceiling got the U.S. credit rating downgraded for the first time ever. Markets lost trillions in weeks, all over a political standoff. Those weren't financial crises, they were psychological ones. Because the entire world economy rests on a single assumption, that the United States will always pay. That assumption turned debt into America's most powerful export. Other nations trade goods. America trades promises, and that's the paradox. The U.S. doesn't need to eliminate its debt, it needs to maintain it. If Washington ever paid everything off, it would collapse the very system that sustains it. Debt is no longer a liability, it's the product. But even the strongest faith can crack. In 2025, U.S. debt surpassed $38 trillion. Annual interest payments alone are approaching $1 trillion, nearly what the country spends on defense. The government is borrowing to pay interest on money it already borrowed. The machine works, but it's grinding louder every year. Meanwhile, political brinkmanship has turned the debt ceiling into a hostage. Each time Congress threatens default, investors flinch. Foreign buyers are trimming their treasury holdings, central banks are quietly buying gold again, and countries from Brazil to India are exploring trade systems that don't rely on the dollar at all. So what would a real default look like? Not a crash at first. It would look like a pause. A single missed payment. A quiet technical glitch explained away in a press release. But behind the scenes, every trading desk and central bank would feel the air shift, because the unthinkable would suddenly be real. In the first hour, markets would freeze. If treasuries aren't guaranteed, banks can't lend and hedge funds can't borrow, the world's financial plumbing would seize. Stock prices would plunge not because companies stopped making money, but because the foundation of valuation would vanish. Then the panic would spread. Foreign central banks holding trillions would scramble to protect themselves. The dollar would collapse as investors flee into gold, euros, anything that looks like certainty. Credit cards, mortgages, car loans, unaffordable overnight. Within a week, the government couldn't pay soldiers or social security. Within 2, the global economy would be in cardiac arrest. And yet the real story isn't about numbers, it's about faith. Because America doesn't just print money, it prints trust. And if that trust breaks, there's no central bank on earth big enough to fix it. Every empire has faced this moment. Rome had its denarius, Britain had its pound, and both learned the same rule. A currency lasts only as long as people believe in the empire behind it. When that belief fades, even the strongest metal turns to dust. The irony is that this disaster wouldn't happen because America ran out of cash. It would happen because it ran out of cooperation. The U.S. could pay its bills in a second it controls the world's printing press. But if political paralysis blocks that ability, the result is the same as insolvency. Confidence doesn't care why the check bounced. That's how empires end now. Not with invasions, but with diversification. Not with collapse, but with indifference. The world won't fight the dollar. It will simply stop needing it. The United States built its empire on a paradox. Infinite debt backed by infinite trust. For now, that trust still holds. But faith, like any currency, depreciates when overused. Because the truth is simple and terrifying. The world doesn't run on money, it runs on trust. And trust is the one currency no nation can print. Thank you for watching all the way to the end. If this gave you a new perspective on how money and power really work, hit like and subscribe, because history always has the answers. You just have to know where to look.